Hi everybody, welcome back to my channel. This is Oliver Wiedmaier at Ollie underscore all caps on Twitter, founder of Voyage Trading Group. Today we're going to go over gap ups and EPs. I do find that there is an art and a science in trading these, and you will see what I mean in a little bit. The first thing I want to do is discuss what happens after the gap up. So if this is the gap up day one, we have a few scenarios. So we either continue the momentum, and then we have a small uh, consolidation, and then followed by a range expansion, right? So you have the gap up, then it moves for a few days, consolidates, and then bam, has another breakout. Or it consolidates for one day inside the range, and then it follows through immediately. Okay, so that is another scenario here. Another scenario is it does this sort of bottom bounce maneuver here, where it will trade inside the range of the gap up, and then it will have a strong move into new highs from the kind of consolidation inside of this gap up range, or it just fails. And we see that a lot, which is why we are going to talk about the techniques and tactics I use to protect myself. So what I do is I want to get involved in the gap up as early as possible. And when I say that, I don't mean buying the opening range. That is a really, really volatile and hard place to get in. When it works, and it works great, you make a lot of money. But statistically speaking, it is just much more difficult trying to buy here than it is to do it the way that I trade these, which is buying near the close. And so how does that work? So we're going to buy a small position at near the end of the day or at the end of the day, and we're going to put a stop loss at the low of the day. Okay, or you could put it at half the range, but using the low of the day here is a way to avoid getting knocked out if you have this sort of action. So if you are newly implementing this, I recommend doing low of the day. That way you can have some wiggle room here. The action near the gap up day is very volatile, which is why you can make a lot of money doing it, but you get stopped out quite a bit if you run it too tight. So on the first day, you want to risk either 0.15 or 0.25% of your total account. And that is just going to get a foot in the door. Okay. That is how we are going to participate as early as possible. Now, in this type of scenario, you make that entry here, it goes up for a few days. You can either take a partial or you just let it run. You could move the stop loss up to break even once it's out of this range. And then once it consolidates for a few days, you will want to make an entry at the next logical entry, which would be a range expansion after a consolidation. And so in doing that, you would have your next entry up here, and then you would move that stop loss low the consolidation here or low the day for that range expansion. Okay, so that's one way to do it. If you have the entry here, you would not make another entry here. You would wait for the consolidation to happen over here. Now, you can, if you want to get aggressive, you can definitely add once it breaks the high, right? I call that a second day play, but that would be more of a aggressive tactic. And then if you did that, you would just move your stop loss from the low of the day to, again, that next logical breakout candle, which would be a range expansion after a consolidation. And then you would just continue trailing your stop loss. Now, if this happens, right, how will we trade it? Well, we know that we would have an entry near the close, right? And we know that we would have a stop loss at the low of the day. So if this happens, we don't do anything, right? But we know that we have built a system to trade bottom bounces. So you would just trade this like you would trade any bottom bounce, okay? And once it breaks into the new highs after the exhaustive selling, you would just treat it just like any other momentum bottom bounce here. You have the stop loss here, and then hopefully it moves higher, and then you would just, again, trail that stop loss. Now, if it doesn't work out, this is the benefit of starting small. You have this entry here, and you have your stop loss at the low of the day. You would have 2 days selling, right? And then the third day selling, you would get out, but you would only take a minimal hit on your account. And if you do this, over and over and over again, the winners will take care of the losers. But of course, we need to make sure we are always trading with a stop loss. So let's look at this with some chart example. So here we have DraftKings, and I would like to say before we get going, we need to understand what a qualifying entry for that day one is. So it needs to close above any recent resistance, okay? And it needs to close in the top 30% of the candle. So if it closes down, like for example, this gap up here, if it closes down, we're not going to enter on that day. Again, this would not qualify for an entry. It needs to close at the high of the candle, okay? So that is another caveat, okay? This closed 66%, so this would not qualify for. So just implementing that rule will save you a lot of negative action post the gap up, okay? So let's try and find some qualifying. So this is qualifying, right? And so you have your entry here, okay? And then you have your stop loss here. Then you have a couple days up, consolidates. This would be your next entry, right? Because it's a range expansion after the consolidation. So you would have entry here with your stop loss either here, or you could leave it a little bit lower, right? If you want to try to trail it, you want to leave it a little bit lower than the 9 EMA. And then depending on how tight you ran it, you would either stay in and catch this move, or you would have been stopped out here. But always typically for me, for these types of moves, it's very volatile around the gap up, right? And so you want to leave it a little bit wider than usual, which is why I like to trade it this way. I want to leave it a little bit of room to wiggle once we are until we are out of this volatile area here. So that is one example. And MU is a great example of why we want to keep gap ups on our watch list. So this is a gap up. However, there is no entry here because it closed negatively. But we want to keep it on because we will take entries, like I said, for these bottom bounce type moves. So you would take an entry as it breaks the high here, and then that would be a really positive trade. You would maybe, you have a consolidation here. You would maybe take another entry here, move the stop loss here, and then you'd be selling into the strength here, and then ultimately you'd be stopped out somewhere around here. So that is definitely another way to trade these. Trade the ones that are negative on day one. You keep them on your watch list, and you look for that kind of bottom bounce type of move. Let's see if there's any other examples here that we can use. Okay, so you have a big gap up here, right? Closes at the high, near the high. You would have your entry here, stop loss here. You would definitely want to maybe take a peel somewhere around here. And then as it's breaking out again, you would add, and then definitely want to be selling as much as you can, and then trailing that stop loss. I like to trail on the 9 EMA, but again, this is another way to do it. You want to try to get out of this area and then start your trailing. Okay, let's look at VRT. Whoops. Okay, so again, this is a negative trade here, and you want to wait until there's a valid entry. And so the valid entry would be probably here because you have this consolidation here, and then you have a range expansion. So keeping it on your watch list all through here, and you're just waiting for that entry. And so this is more of a delayed entry. But let's say you take it here, right? You no more entry, no more entry. Then you have this nice big gap up, right? You can just trail it, and then you're looking for either a red flag, or you're looking for a valid next entry. You never really get another new entry, but again, you capitalize on this massive move. It is a smaller position, however, you are trading it, 60 or 70%, and so it might be smaller, but you know, these types of moves can really, really help turn your account. Let's take a look at Dell again. So you have this big gap up here. It closed 67%. So this is not a valid entry here. So you will just wait until you get tight closes and then a range expansion. So you could have traded this little momentum burst, but there's no real other entries to be found. Okay. And again, you have this gap up here. It's a negative close. You do not enter here. And then you wait. This is a good entry here because you have this consolidation, right? So this is still valid to, in a definitely a way to trade EPs. It doesn't look like what you typically see, but this is exactly how I trade them. I'm waiting for a the very first breakout after the day one on the gap up, and this is a valid entry here. You'd buy this, right? Then you would look. This is another valid entry because you have two tight closes here, and then you would be selling into all of this. Okay, and then you would of course be trailing. So this is again a delayed reaction using the tight action and the range expansion, just like you trade any other breakout, right? But you're using these gap ups to find these trades, and you will hopefully make a lot of money by sticking to these simple rules. So you have a gap up here and it closes negatively, right? But then you have this range expansion here. So you can definitely take an entry here, right? More of a delayed entry. And then you would have your stop loss here. It goes up, goes up, goes up. This is another definitely a place to add. You would have your stop loss here. It moves up, moves up. And then hopefully you are taking peels and you're trailing. Okay, let's take a look at here. This is definitely valid, right? So you buy here, you have your stop loss here. It never violates, right? You get a bottom bounce. You can add here, maybe add here. And then you definitely want to take peels into the strength. Okay, and again, you're going to be trailing along the way. So let's take a look. This is a good example here. You have this gap up here, right? But you have a lot of near resistance here. So I wouldn't particularly take that, and it rejects the 200-day moving average. But for me, gapping into resistance is a red flag. I don't want to trade that. But let's say you did. You take it here, stop loss here. You could definitely add here, stop loss here, and then you would end up stopping out here. Let's take a look at SG. Okay, you have this gap up, right? So we're still waiting for the next valid. This is technically right here is a good entry, right? Because you have the tight action after the gap up. So you would take the entry here, but then you would have been stopped out here. But it's choppy, right? It's choppy. It has not broken out of that range. And so that's what we're looking for. We're looking for it to get out of this range. And so if it does a nice little breakout up here, then that would be your delayed entry right there. You would not have traded this because it does not close in the top 30%, but you would enter here because it's the first valid breakout after the gap up, right? So you have two tight closes here. You'd buy that entry here. You would immediately move up your stop loss there, and then you would just trail. At some point, you'd be taking some peels, and then you would either get stopped out in this area, or if you had a little bit lower of a trail, you get stopped out here. But that's a solid trade, 27% or so. Let's take a look at a couple more. Okay, here's a great example, right? So you have the gap up here. Okay, you take your entry here. This is really wide, but you could either have your stop here or you could have your stop here. You don't add anything here. You add here, right? And then you move your stop here. There's no valid entries up here, right? We want to add on the first available breakout, which would be either a consolidation breakout or a bottom bounce type breakout. So you're getting this V, right? So that's your bottom bounce. So you want to add here, you have your stop here, and then you just start your trail. Okay, so this is excellent action here. You want to get in as early as possible, not down here, but as early as possible in the move. Okay, this is a multi-day, multi-week type of move. And then you want to add the first valid entry after it breaks out of this range here. Okay, last one, NVAX. So again, so you have this negative day here, but you have this big breakout here. So this would be your valid entry. Okay, and you have your stop loss here, and then you would be trailing. And so yeah, I mean, a solid trail would be here. This is a nice shakeout candle here, so maybe you do a stop loss here. But again, you're just letting it work. You're letting it get out of this volatile area here, and then you want to trail. Okay, so if you did this, you would still be small now, but you would be waiting for it to consolidate again, and then you would have your breakout of the consolidation, and then you peel and trail. And so these are the different types of post action, post gap up, post EP action that I'm looking to get involved in. The most important thing for me is for it to get out of the volatile range in the very beginning. I want to get in as early as possible, and I only want to risk a small amount in the very beginning and then add to all the valid breakouts after. Hope you guys learned something. Please give it a thumbs up. Thanks a lot.